Ladies and gentlemen, welcome to this GoviEx Uranium presentation at 1-to-1. I'll take you through our projects in Africa and our view on the uranium market. Here's our standard disclaimers and cautionary statements. I'll allow you to review those at your own leisure at a later date. So GoviEx has been around since 2007. It's a focused company, all in Africa. We have 3 major projects. We have large mineral resources, and we've got a lot of exploration upside. The key target, though, is on the development of our mine permitted projects, and namely the Madaouela Project in Niger. We're focused on optimizing the pre-feasibility study for it reducing OPEX and CAPEX to being able to target the debt and offtake markets with rising uranium price. As I said earlier in my opening, all of our projects are in Africa. We like working in Africa. It's a jurisdiction where we are working in mining targeted areas. They're jurisdictions that we can get things done, particularly in Niger, where since the early 1970s, 60 to 70% of that country's exports have been uranium. It's the 4th to 5th largest producer of uranium globally, accounting for about 8%. And it has stable government and stable mining laws to go with it. Similarly in Zambia, a copper-focused jurisdiction looking to diversify, and in Mali, which is now becoming one of the largest gold producers in the world. Just briefly on the market, and this is a presentation slide from the World Nuclear Association, where the industry itself has reviewed where it believes the market's going to go. And what that slide is showing is we're looking at strong growth for the demand for nuclear energy, driven by China's growth and need for it, driven by consistent stability out of the US, out of Europe, and growing development regions. So we're looking at about 2 to 3% growth going forward. The concern for the industry is the red area under that top line, which is the deficit we currently find ourselves in. We've had major cutbacks by the industry that have placed the market in a supply deficit. And really, this has been driven by the major producers who in the last couple of years, namely Cameco and Kazatomprom, have shut mines and or reduced the output from their mines to force the market into supply deficit. This was exacerbated by the impact of COVID, which saw the closure of both of the major mines in Canada and a closure of the long-term development by Kazatomprom. Those are now both up and running, but are having a major impact on the supply of uranium in the market. And we've seen the positive effect of that to the price. But looking forward, we're going to have to deal with the closure of mines in Niger and in Australia, which will further increase and widen the supply gap that we have out there. The problem the industry has is that we need a $50 to $60 price to be able to incentivize new production, in fact, even existing production to come into the market. Cameco have made it very clear that their McArthur River mine will only restart when they can get a $50 price. Kazatomprom, who've got a 20% supply production cut going through at the moment, will only start to increase their supply above that level when McArthur River comes into production. So we're looking at supply gap expanding. We're looking at a need for a higher price to allow the producing companies to come back and start to refill. And at the same time, we're looking at good stability and growth on the demand side. So where does that put GoviEx? We're all about development. We're about seeing that price rising and bringing our projects into production with that development. And that is key, because if you looked at the previous cycles in the market, in the 2007 market, when the uranium price went to $130 a pound, the key performing shares at the time were the 2 companies that were able to go from being developer to being producer. They far exceeded the returns that you got from the sector average. And so that's one of the key strategies for GoviEx, is to bring its projects into development. So we start with Madaouela in the middle of the Sahara Desert. Average rainfall is about 10 millimeters of rain, hence my friend the camel in the desert there. But what's key to us is that we have all the infrastructure. We're next to the Areva mines of Cominac and Somalia. We have a main road that comes straight past our property. We have a power line, and we have water. But importantly, the Cominac mine is due to close next year in March. And that means there'll be a substantial labor force fully trained in mining uranium looking for employment And that is one of the reasons why we've had so much support from the government, as a need to get those people back into employment in the industry. We have very strong support from the government, and to the point we did a deal with the government last year to remove $14.5 million of debt from our balance sheet that was owed to the Nigerian government. In exchange, they took a 10% stake in that project. These are the numbers from the 2015 PFS that we had. It showed a 21-year mine life, producing 2.7 million pounds of uranium per annum over that time period. Capital is about 360, and we're going to produce at just over $24 a pound. But that's where we're really focused at the moment, is on that pre-feasibility study, making it more bankable, removing the risks that are associated with the technical decisions that were made, reducing the operating costs and the capital costs, and to take that pre-feasibility study, which we're expecting to be completed in the latter half of this year, so that we can go to the debt providers. We've had a lot of interest in debt financing in Niger, so we know it is debt financeable, but also to contact the off-takers and continue our discussions with them. So that's going to be a real catalyst for the company going forward, is that pre-feasibility study, where we're trying to bring that incentive price for uranium down for what we need for its development. But different to many of our peers, we have other projects within our group. We have the Mutanga Project in southern Zambia up against Lake Kariba. It is a very simple open pit heap leach operation, very low capital costs associated with this. It's a third the capital of the Madaouela Project for the same production rate, but it has a higher operating cost due to its lower grade. We do have an issue on this property, and we have a license under review, the Chirundu license. We have appealed the government's decision on that one. It's very small in relation to our whole project, and will not make any major impact, particularly given the amount of exploration upside that's associated with this property as well. And then lastly, we have the Falea property. Falea has really changed in the view where we were earlier this year after we did some gold exploration on the property. And we've realized that this property is actually on two major gold trends. So while initially it was a uranium property with very strong copper and silver credits, we realize now that it's actually underlying by the potential of gold. So we have four major minerals contacting in the same area. So looking forward on this, and for the rest of this year into next year, we're going to be doing induction IP work on it. We're going to do some drilling early next year to better understand the multi-mineral potential of this property and to see where it sits in our pipeline of projects. We have an experienced team here. Myself, I'm from the university in the UK. I've worked all over the world. I've also worked as an investment banker as well. My chief geologist, Jerome, again, has worked on most uranium jurisdictions and most uranium types around the world, and a very strong technical advice from Rob Bowell, who's actually built his own personal copper mine and understands the concept of putting things in for low capital. We've got a strong board with Govin Friedland, the founder of the company and the son of, one of the most profound entrepreneurs of the mining industry, Robert Friedland. We have David Cates, the CEO of Denison Mines, Christopher Wallace, who's a debt financier, and importantly, Benoit LaSalle, who, with the founding of Semafo, really opened up West Africa to mining. We have strong sponsors for the company who've been with us for a very long time. We have a debt on the balance sheet for $4 million. This is due to the Nigerian government for the area taxes that we held, but it's not due until July of 2022, when we'd expect to pay it out of the debt financing for the project. We've just done a cash financing. We've got about $3.5 million into our books at the end of July, early August, so we're well cashed up for the next year. And really, just back to one of my earlier comments about where to invest, there are two good examples. As I said before, in the 2007 cycle, the primary investment argument was to get into companies that could go from being a developer to being a producer and get that massive re-rate. The two companies that did it, one of them went 5 times higher than the sector, and the other one doubled what the sector average done. In addition to the 2011 cycle, the best performing shares were the takeout stories, and the 3 biggest ones of those were in Africa. So GoviEx brings that ability to look at transactional value or re-rate from being a developer to being a producer. So just to summarize who we are, we're an experienced team. We're focused on uranium in Africa. We believe in the fundamentals of the uranium market, but our key is having those permitted projects and being able to develop them into the market. And so very much focused on that development of that Madaouela project with its mine permit, but we've got the other projects to add further value. Thank you very much for listening to me, and hopefully I will see you at our booth.